If you're a parent and you're looking for a way to set your kids up for financial success long term, but you don't know where to start, then this video is for you. A lot of parents want to invest for their kids, but most people assume it has to be complicated, risky, or time consuming. And it doesn't. You don't need to be a stock market expert, you don't need to watch the market every day, and you definitely don't need to pick individual stocks. In this video, I'm going to walk through a simple, long-term investing setup parents can use to help set up their kids for financial success over time. We'll cover just 3 ETFs, SPY or SPYM, QQQ or QQQM, and SCHD. And I'll explain what each one does and why this kind of setup makes sense when you're investing for kids. See, the biggest advantage that kids have when it comes to investing is time. When you're investing for a kid and you think about the amount of time that their portfolio will have to appreciate, you're looking at around 15 years, 20 years, and sometimes even longer. The time horizon allows compounding to really do its thing in this case. And the best part is it doesn't require huge amounts of money. Even small, consistent investments like $25, $50, or even $100 a month can grow into something meaningful over time if you stay consistent and let money work. This isn't about getting rich quick. This is about building a financial head start. Let's start with the foundation. In this case, you're going to go with something like SPY or SPYM for the lower cost version, both of which track the S&P 500. This means instead of trying to pick individual stocks, you're owning pieces of 500 of the largest U.S. companies at once. These are businesses that drive the U.S. economy, companies that have survived recessions, market crashes, and economic cycles. For parents, this works really well because it's diversified, it's historically grown over the long term, and it doesn't rely on guessing which company will win. This is the type of investment you can buy, add to regularly, and hold for years without stressing over day-to-day market noise. If someone asked me if I could only pick one investment for a kid, this would probably be it. Next is QQQ, or you can opt for QQQM, which is the same thing but just cheaper. This ETF focuses on the NASDAQ 100, which means that it's very growth focused and tech heavy. You're getting exposure to companies that tend to lead innovation and long-term growth. Now, this does come with more ups and downs than SPY or SPYM. You'll see bigger swings both up and down. But when you're investing for a child with decades ahead of them, short-term volatility usually means a lot less. You're not trying to time the market here. You're trying to participate in long-term growth. This is the growth engine of this portfolio. The third piece is SCHD. This is a dividend-focused ETF that has a list of high-quality companies that have been historically paying and growing their dividends over time. Now, this isn't about generating income for your kid right now. Instead, the real benefit here is reinvesting your dividends, adding stability, and smoothing out the portfolio during rougher markets. Dividends that get reinvested buy more shares, which then produce more dividends, and that compounding effect adds up over time. This helps balance out the growth-heavy side of the portfolio and keeps things a bit more grounded. If you want to keep things simple, here's one basic way of how a parent can structure this portfolio with these 3 ETFs. First, you can put 60% into SPY or SPYM. Then you can put 25% into QQQ or QQQM. And then lastly, you can put 15% into SCHD. Now, keep this in mind. This isn't the only way to do this. And it's not a rule. It's just a clean and easy starting point for most people. Now, the most important part is that the exact percentages don't matter as much as the consistency when it comes to putting money into this portfolio for your kid. One thing I really want to mention are fractional shares. See, what happens a lot of times is that people will see the prices for stocks or ETFs and think to themselves that it's too expensive for them to get started, and that couldn't be further from the truth. See, you don't need to buy a full share of any of these ETFs to get started. Most brokerages will let you invest any dollar amount. So if all you can do is $25 or $50 at a time, then that's completely fine. What matters isn't how much you start with, it's that you start at all. Now, a lot of parents will use what's called a custodial account with their brokerage to get started investing for their children. A custodial account just means that you have an account with a portfolio that has stocks in it that's intended for the children or the child, but the parent is the one that manages this account. Now, when you zoom out, this isn't really just about money. You're giving your child time, opportunity, and a financial head start. Even if they never become investors themselves, they'll still benefit from the groundwork that you laid. Now, with all that said, you know I'm not a financial advisor. This isn't advice or anything like that. But this is how a lot of people get their kids a financial head start when it comes to setting them up for their future. You'll see a lot of people do this in preparation for their kids getting ready to go to college someday, starting a family, buying a house. The possibilities are damn near endless, right? So with all that said, make sure you like, share, and subscribe, and follow for more beginner-friendly stock content like this. And let me know what kind of investments you have for your kid. I'd love to read the comments and chat with you more. Take care. See you in the next video.